You've heard about investing in the stock market, but what does that actually mean?
How do you do it?
And how do you go about doing it?
Well, in this video, we're going to give you the 3 main ways you can invest in the stock market and tell you which one we use. The first is called stock picking. This is where you pick a certain company. Let's say you pick Amazon or Apple or Tesla, who knows what it is. You pick a company because you believe in it, because you think it's undervalued, because you think it'll make profit, and you buy that individual stock. Now, this comes with some risks because you are investing your money in one company. And what if that company doesn't do well? What if it goes bankrupt? What if it has problems? Stock picking means that you think you know which of all the companies out there are going to be successful. And that's a big gamble because you just don't know. My dad got involved in stock picking. We've seen so many other families get involved in stock picking. Those stocks do badly and they lose a lot of money. It was part of the reasons my family ended up in a financial mess, is because the stocks my dad picked did not do well.
So maybe you say, okay, I don't want to choose which stocks to buy. I don't want to choose these companies. I'm going to ask someone else to choose. And this is where you have actively managed funds, meaning that someone is actively choosing what companies to buy on your behalf. You give them your money, and you say, off you go and choose which companies to buy. And the aim of these funds, these actively managed funds, is that the fund managers think that they can get a better return for you than if you were to buy all the companies at once. And they don't actually manage to generate a better return on average. So between 1984 and 1998, which was 15 years, only 8 out of 200 fund managers managed to beat the Vanguard 500 index, which is the 500 biggest companies in the States. And 8 out of 200 people, that's 4%. And so only 4% of people got a better return than the average market return. And the real kicker is that 4% of managers changes every year.
Single year.
So maybe 4% are successful this year, and then a different 4% are successful the next year. And these active funds, they're a little bit cheeky because the ones that don't do so well are folded into a more successful one so that they can say that they are outperforming the market. And we kind of forget the losers.
We forget the losers. And it's really interesting. The other part about this that I don't think people really know is that you pick a fund manager that you think will do well for you, but you are paying heavily for it. The fees for actively managed funds are high. And when I say it, you're not going to think that's very high. They'll charge you 1 to 2%. Doesn't sound like a lot. 1% does not sound like that much money, but compounded over the years, it is a fortune. Fees destroy the performance of your market. So if the market on average returns 12% and you're paying 2% fees, you need to get a 14% return to make up that difference.
When we first started investing in the stock market, I didn't know what I was doing. I didn't understand.
Neither did I.
A phone call whilst I was at work, and this man said, have you thought about investing your money? And I thought, that sounds good.
We wanted to invest.
We want to buy assets. And that was with an active fund manager. And that was with an active fund manager, which charges these higher fees. And we did the sums and we worked out that if we had stayed with that fund manager over the years, we would be £315,000 worse off from being with these people that claim that they can make you more money because you're paying them. We're the professionals. We will make you more money than you can by just investing in the stock market on your own.
£315,000 evaporated because they promised they could do better. And that comparison is compared to the third way of investing in the stock market, which is passive. It's index funds. So instead of saying, I can pick certain firms, or actually instead of saying, I can't pick certain firms, I'm going to get someone else to pick them for me, what we're saying is we're not going to pick at all. We're just going to buy a slice of every single company in the market. We're not going to pick. Let's just own the whole market.
And the way that we do this is that there's these fund providers that amalgamate all these companies for you and automatically rebalance as companies come in and out. And we use Vanguard, and they have extremely low fees. So the fees are way less than 1 to 2%. The fund that we use has 0.15%. That's so little in comparison, and that compounding is not working against you with the fees in the same way as they do for the actively managed funds. So we buy low cost, meaning low fees, Vanguard index funds that buy a small piece of every single company in the index, and you buy them across the world, globally diversified, meaning you're not just choosing one company, you're not just choosing one country, you're not just choosing one industry, you're buying each and every single company that's available to buy.
So you're very diversified, which means the concentration risk of buying just one stock evaporates because you're diversified across all these different things. And the really fascinating piece here is that an index fund gives you average returns.
I don't want average returns. That sounds... I'm an above average person. I should be getting above average returns, Alan.
Well, that's what people say to us. They say, I don't want average, I want better than average. What they don't realise is that average returns is better than nearly everyone in the market, because actively managed funds and most stock pickers, they never achieve the growth that an average return is. So average returns are not average. It sounds strange, but they're not. And those are the three ways to invest. So you can stock pick. You can decide I'm not good enough to stock pick, and you can pay someone else to stock pick for you. Or you can go, I'm not interested in stock picking at all. I just want to buy a little slice of everything within index funds. You can probably already tell what we do.
We talked as well about the passiveness of these different things, and actually the way that we invest with the low cost index funds is the most passive. We're not choosing, we're not picking, we're just saying, we want to buy a small piece of every company in the market, put my money in that index fund, and away we go. I don't have to choose a fund manager that I think is going to do well. I don't have to decide which companies to invest in. I just passively say, I want one little piece of every company available.
So the Donegan strategy for investment is to buy passive index funds, to put money in there and to hold forever. And we invest in like a Vanguard global index fund. That's the type of fund we use. We got a video coming up which actually explains what is an index fund.
Yes, so we'll go into more detail there. A little bit of knowledge is a dangerous thing. We've probably said a lot of terms during this video that you're scratching your head saying, this doesn't make sense. I don't know what this is. Please go away, do some more reading, watch some more videos, learn more about what we mean when we talk about investing in index funds. We've got a whole series of blog articles. If you go to alandonegan.com/investing, that's where you can start to learn and read and go into this in more detail.
Because learning the world of finance is quite often like learning an entirely new language. There is a whole bunch of words that don't make sense, and I want you to treat this just as you would learning a new language. Any word we've said that you don't understand, look up the definition, start to expand your knowledge. The better you improve your financial knowledge, the better you will improve your finances over the long run.
Please subscribe now.
We talked about 3 different ways to invest in the stock market. Next video to watch is what is an index fund, which will break down exactly what you're getting into, and then move on to how to invest your first 100.